Hello and welcome back to your Mortgage Market Movers Weekly, where we are detailing everything that is going on in the macroeconomy to help you make better home buying decisions. This week's 30-year fix is sitting at a 6.75, which is up about 3 basis points from last week's 6.72. Not really a big deal. Last week I had assumed that things would come up just a little bit, but things are still not as elevated as they were in the previous month. So things are still looking good for the interest rates. Not a ton going on this week on the economic calendar. However, we do have a few important events that we will want to keep an eye on. So we'll get over to the charts and discuss those now. Back over to the charts. So it looks like really when we look at the US 10-year yield, things are just kind of going up and down, up and down. A little bit of a roller coaster action here. Not anything crazy. And I mean, I think that right now, rates probably won't do anything too wild. The stock market still is doing well. It's hitting all-time highs. The bond market is also doing fairly decent. We can pull that up right here. So as we can see a little bit today, we had some buying action, and that is why we are seeing this decline in the US 10-year yield. But really, I mean, nothing crazy is going on. In order for the interest rates really to make any jumps in either direction, up or down, we would really need to see just a little bit of either buying or selling in the bond market, and that's not really happening. It's right now really just staying pretty tame, pretty controlled right now. So not, obviously everybody wants to see low rates. I'm sure some people are still holding out for 2 and 3%, but it just doesn't look like that's going to happen anytime soon without any kind of big catalyst, right? So, like I say, it's important to keep in mind this isn't always the case, but oftentimes the bond market and the U.S. stock market are correlated. So unless there's just a huge drop in the stock market and a huge run in the bond market, we aren't going to see rates drop too much. So we just want to keep an eye out. We want to keep looking at economic events to see what's going on in the economy, and we want to use that information to see if it's more likely that people are going to be buying into the bond market or selling off bonds, right? Now, when we take a look at the economic calendar last week, we already discussed we had CPI, PPI, so inflation indices. This is consumer side, this is producer side, and inflation was looking not too bad. It wasn't as bad as the consensus thought it was going to be. We do see retail sales are doing well, so it looks month over month for, I want to say this is the month of July, I would think. I'm not exactly sure, but month over month, retail sales are up, so consumers are spending money. That's good. Unemployment claims. The labor market, as this has been the case for a good bit now, the labor market has been fine. Nothing too crazy. It's not as if unemployment is running rampant and nobody can find jobs. Unemployment claims have been coming down. The job numbers are fairly solid, so nothing too crazy there. When we get to building permits and housing starts, it looks like there are more housing starts, so that's good. I want to say this is new construction. Yeah, new residential buildings during the previous month. So new houses are being built. As far as the University of Michigan, it looks like a little bit more optimism about the economy, so that's really good. Previously, the inflation expectations were at a whopping 5%. Not great, but they came down to 4.4% for this survey for the University of Michigan. So that's good. When we look at this week, really the biggest thing is probably this. Anytime Powell talks, Jerome Powell, he is the chair of the Fed, of the Federal Reserve. That's always going to be a big deal. So this is going to be July 22nd at 8:30 a.m. Powell speaking. We always want to listen when Powell's speaking. He really can move markets based off of little words and little hints towards what the Fed is thinking as far as interest rates, whether there's going to be cuts or rate hikes or pauses. And when we talk about interest rates, we are talking about the Federal Fund Reserve rate, not the 30-year fixed. We also have existing home sales, which that'll be good to look at, of course, on the 23rd. And then 24th, we have unemployment claims. Then we also have manufacturing and services PMI. And this is just a survey from purchasing managers. And it's really just looking at how well manufacturing is doing and then how well the services are doing from purchasing managers' perspective. So we want to see good numbers on those, see that manufacturing and services are still going strong. We also have new home sales on the 24th. So not really too much going on. Like I said, it looks like things are just kind of really in this range of nothing too crazy going on. I don't expect rates to do anything crazy. I don't expect crazy new highs up to, like the 7%, but I also don't expect anything to come down low to 5% or anything like that. Unless there's some kind of catalyst, and we just don't have that right now. So, that doesn't mean that can't pop up. But as of now, it's not as if there are any huge events on the horizon where we need to keep our eyes open. So we just need to be aware of what's going on in the economy, be aware of, any potential changes. Things can happen very suddenly, very rapidly. So let's keep an eye out. And like I said, 6.75 up from 6.72. That's really all I have for you this week. So if anyone is looking for a mortgage, if this would load, okay, please visit Mortgages by Linda at mortgagesbylinda.com or give us a call at 877-TEAM-MBL. All right, have a great week, everyone. Bye.